Hello and welcome to CIO Perspectives. I'm Sid Ahl, the Co-CIO for Private Clients, Endowments and Foundations here at Brown Advisory, and I'm joined today by my Co-CIO Erika Pagel. We're excited to have with us today Jon Lewinsohn, a founder and managing partner at Diamet Capital Partners, a leading credit investment firm with activities across public, private, and structured credit, from performing to distressed. We've been invested with Diamet since their launch in 2017. In addition to their skills in credit research and trading, we've always found Jon, Scott, and their team excellent big picture thinkers about the broader economic landscape, inflation outlook, Fed policy, and the changing competitive dynamics within various industries. We're excited to have Jon on today to help us make sense of all that's gone on in the investment world this year, from tariffs to AI, and also talk about where he's finding opportunities in the fast-changing world of credit. Stay tuned after our conversations with Jon when Erika and I reflect on takeaways.
Do I get to hear those takeaways too?
You can stick around for them at the end if you like.
Just kidding. I'm sure you'll be gentle with me. Great to be here.
We're always gentle. It's great to have you with us today. Could you just kick us off with a bit of your background and your investment career? How did you and Scott come together to form Diamet?
Sure. And I'm sure this is a bit boring, so I will try to go through it as quickly as I can without talking too fast. Scott and I met in 2010 when we were at a firm called Anchorage Capital. Scott was the head of trading. I was the head of research. And we really created a bond. What we realized early on is that you want lots of different ways to win. And credit, where liquidity is discontinuous and where oftentimes people are looking more backwards at trailing EBITDA as opposed to forward EPS, if you put together a view on what the assets are worth and a view on how the liabilities will play out and have a view on the trading technicals and have a view on how people will buy and sell, you can create alpha up and down the credit spectrum. You don't have to wait for a recession to buy distressed, or you don't have to force yourself into buying a kind of a crappy distressed business. You can maybe do really well in stressed or really well in performing a new issue. And, we were middle management at Anchorage, so they took some of our ideas. We didn't think enough. And so we started thinking about, wouldn't it be great if we had our own firm one day?
You now invest across public and private markets, but you touched a little bit on maybe your investment philosophy or kind of how you're looking to generate alpha. But more broadly, how would you describe your investment philosophy?
This job is really hard. Everyone is very smart. Everyone, it seems, has similar abilities. Everyone has Bloomberg and everyone can calculate EBITDA. And I actually sit with our newest hires, our youngest people, and I say, how are you adding value here? I used to say compared to us outsourcing modeling to cheaper jurisdictions. Now I say compared to AI. And what does it mean to kind of add value? And we can get into kind of the type of investments we like, but really we think that everyone's smart, it's competitive, and the way you can consistently win and deliver alpha to our clients is to have a process that allows you to be safely faster. So if you're too fast in life, especially if you're not wearing a seatbelt, you'll crash and die. And we all know that from our personal lives. And what we want to be is find a way to be smart, and most people are smarter than us, and fast together across asset classes. And we're obsessed, Scott and I, with how do you have a process that allows you to be smart and fast? And that supersedes our investments in everything we do, from in our hedge fund, which is kind of trading actively, to our delayed draw dislocation funds that are doing syndicated credit, but less actively trading, to direct lending, where we don't trade at all. But we want to be able to come in and quickly tell sponsors or non-sponsors, hey, yes, we want to do this loan, or no, we don't. And that really overrides our philosophy. I'd say more generally, away from that approach, we want to find things, and I alluded to this earlier, with multiple ways to win. And that's why I look at my friends who do equities, and God knows equities are so hard. And you're saying, okay, I think we'll beat earnings, or I think this stock will go up for this reason. What I love about credit is there's so many different angles I can take: a liquidity view on the company, an asset view on the company, a restructuring view on the company. Sometimes it's just technical, like who's buying, US double Bs. And we try to find ourselves in situations like that as much as we can across our business.
Maybe another key thing you could touch on, how can you be fast? Can you talk about just how you organize research in order to be fast? How's the team structured?
I think we do a lot of different things that maybe I could have gotten into at first, but we have a hedge fund, we have a dislocation fund, we have a CLO business, we have a direct lending business, we have an interval fund now that puts a lot of those things together. And we manage just over 20 billion, I would say, across those things. And we have different research teams for different parts of that business. So direct lending has its own research team. The CLO has a research team that spends most of its time on the CLO. But the idea is that in order to be fast, you have to be an expert. So I can't tell you how often we'll be covering an industry and a company that somehow we've never heard of all of a sudden hits our radar. It happens. It's amazing considering how long we've been doing this and how many things we cover. But the analyst may never have heard of the business. But if he or she has a macro and a micro focus, so understands what he or she is looking for in the macro space, let's use autos, for example, what I think auto production is going to be this year in different jurisdictions, who winners and losers are within that, and so has this macro and micro model, they very quickly can jump in and learn a new business fast. And so we have industry experts who know their industries, who know the companies that we invest in, the companies that have credit, and the companies that don't have credit, because you have to know all the businesses in order to be able to invest across credit and really understand it. And then we try to avoid them being captured by industry consensus, which really can happen by having them rely more and more on primary data. And once a year, we actually force an offsite where they have to give us their primary data view on the industry. And one thing that differentiates us is we're not a macro fund. We don't make macro trades. I one day would love to be a macro trader, buy Thai bot link notes or something, but we don't do that. But we are very, very, very macro aware. And I spend a lot of my time in macro data. Our analysts are responsible for situating their companies in the macro universe and not just looking at it and saying, oh, I think it's going to grow 2%. Well, management told us it grew 2% last year. What is the state of GDP? What is the state of inflation that allows these companies to grow 2% or decline 2%? And that's what informs our process.
I'm excited to jump into that. I think we will in a second. My last high level question for you would just be, when we first invested, it was single strategy, hedge fund, small, nimble. You've grown, you've expanded into different areas. Could you just talk about what you see as the benefits, both of maybe size and scale, but also of the diversity of those different strategies? What does it bring to the organization, but to investors in the original hedge fund or your drawdown vehicle?
There's no free lunch. So when you're small, there are things that work and things that hold you back. And when you're bigger, there are things that therefore hold you back and new opportunities. So I think it's really important to emphasize that growing is not an unmitigated positive or an unmitigated negative. Scott and I obviously had the opportunity to start this business 8 years ago because we'd worked at other similar firms and we'd been in the industry for a while. And one conclusion we took is that for syndicated credit investing, long, short in the hedge fund, and for distressed debt investing, there was a certain size of AUM that was too big. And the reason is you don't want to be doing the worst type of private equity, which is you have a position that you can't get out of and you actually don't impact the company. Or you're involved in distress and you had all this impact in the restructuring, but you need an M&A event for you to exit your position. And so we've been very, very purposeful in keeping the hedge fund closed for long stretches of time. We've given money back in the hedge fund twice, and we've been hard closed for most of our existence. And the idea is that I don't know what too big is for the hedge fund. I don't want to wake up one day and say, Sid, problem, we're too big, our returns stink. Because then that's really on me. And so we've kept the hedge fund purposely at a size constraint. The dislocation funds, which invest alongside the hedge fund in stress and distressed. Also, I'm gratified by the fact that we could raise a lot more than we've raised, but I don't want to have to wait for a recession in order to invest it. I want to be able to invest in microcycles, which we can talk about. Scott and I are obsessed with what's peppered our career with, not recessions, but industries going through problems that are not secular problems, but are cyclical problems for those industries. And I want to be able to put that money to work. And so as a result, we've limited the size of our dislocation funds. In CLO, in direct lending, you can be much more scaled. And to be honest, we're also running a business. So if every day I came down here and I said to the team, guys, we can't grow. We can't grow. We're size constrained. Even though every day it's more expensive to run the business, I need more data people. I need more analysts. No one wants to work at a firm that can't grow. Those are the type of firms that we like to short. And so having a mix of things where some businesses that can continue to scale and some businesses can't. The key for us is if you're going to start a new business, make sure that it doesn't cannibalize your existing business, it doesn't distract you, and it complements what you're doing. And so even if the good folks at Brown wanted to offer us a mandate to do Chinese equities, we would probably turn you down because it would fail all of those. Well, it wouldn't fail cannibalization, but it would certainly be distracting and it wouldn't complement. And so our CLO business, and I would really tell you, ask managers who do syndicated credit without a CLO business. I can't imagine running the hedge fund dislocation fund without getting a first look at all the loans when they're issued. I can't imagine being able to do capital solutions in the sense where private equity firms and non-sponsors, people coming to the syndicated market without also being able to offer a direct lending option. because those markets have converged. I think we're proud of the fact that the businesses we've started pass those three tests. Scott and I run the hedge fund and the dislocation fund every minute of every day. We make all the decisions, no investment committee. Everyone works for us in a flat organization. But we have really talented people who run CLO and direct lending every day because we couldn't actually do all of that. And so that's how we've managed growing. And I would say, you said you invested in a nimble firm. I think we're pretty nimble still. Our ability to move the net and the gross of the hedge fund hasn't changed since we were much smaller. We've moved it by more than 1,000 basis points, even 2,000 basis points. I don't have this at my fingertips, but well over a dozen times in our time here. And most recent major move was in March. So I don't think our ability to be nimble has slowed down because we've size constrained certain products.
Jon, maybe we can jump back to the macro and would love to just hear your high level thoughts on the economy, just what data points you're looking at and how this would influence your portfolio management.
You want to be macro aware, and you also don't ever want to outsource your macro. What drives me crazy when I hear people saying, oh, well, the Goldman Sachs economist or the Bank of America economist, these people are great. They're great economists. I'm not an economist. I don't even play one on television, but although that might be fun. But they are doing very broad type of economic analysis for a very broad set of clients. And what you want as a manager is to say, hey, what is my view on these important issues? And if you can't get a view on those important issues, well, maybe you don't really appreciate what you're investing in. So let me duck the question on the current economy, but I'll come back to it, don't worry, and go to COVID. We all obviously missed the COVID era terribly. Just looking at a picture of my son on a ropes course, an outdoor ropes course in the fall of 2020 wearing a mask. And it made me both laugh and cry. But we all missed that environment. And we at Diameter, the second we started thinking about COVID, started modeling the epidemiological curves. We'd never done that before. We certainly don't have degrees in public health or even advanced statistics. But we said, this is going to be the defining issue of this year. Frankly, when we were first doing it in January of 2020, we had no idea how defining. We were thinking it in terms of what's this going to do to travel, like SARS had done to travel. And we started modeling curves ourselves. And we started really getting deep into the science. In fact, my Twitter feed, my X feed, still has so many epidemiologists because of how many people we followed, how much data we wanted. And we didn't outsource our views on COVID. And we had our views on COVID. We went from negative to positive. So when we think today, which thankfully as a human being is a much less volatile period of time, we spend an enormous amount of time in the primary data. And the primary data is showing a narrative now that is, I would say, a little weird. On the one hand, we all know that AI is dominating everything. We're taping this in the middle of September. We're starting to think about what we'll write in our quarterly letters. The one time we started writing the letter in the middle of a month of the last month of the quarter, the whole market changed. So we don't do that. We wait till the last week of the month, but start thinking about it around middle of September. What will we write? And I think a chart that certainly is on top of my mind is this second quarter GDP numbers, which we got during the third quarter, was the first time not in a recession, at least this century, and I think farther back, where spending on information processing and IT, the stuff that goes into AI, exceeded the US consumer, and it wasn't a recession. So in a recession, the US consumer collapses, but companies continue with some of the investment stuff that was approved before. The US consumer was actually in okay shape. It wasn't like a terrible consumer number. AI is just eating the world. And so what's interesting is AI is doing great in terms of spending and everything, and the consumer is doing fine. And the jobs numbers are a little weak, and they're hard to fully understand because we've also had this real change in immigration that's happened in the last year. And so there's puts and takes. But my best guess on the economy now, Erika, is that the economy remains relatively fine. And the reason it remains relatively fine is the two North Stars we look at is what's the amount of debt in the corporate economy and what's the amount of debt in the consumer economy. And both are relatively unlevered. And so jobs slowing means the economy is going to slow. Spending is not quite as good as it was, but the economy is fine, broadly speaking. And this is a real pet peeve of mine. We all have to become less obsessed with recessions, and we all have to be able to distinguish between a slowing economy and a negative economy. And the reason this is the case, that we can't do it, is most people managing businesses today, and I'd say it's the same for you, Erika, and for Sid as well, came of age in the financial crisis. We were all doing what we're doing at a more junior level, perhaps, in the financial crisis. And the cost of being wrong in 07 and 08 was so enormous that none of us are ever willing to be wrong again. And so we call 11 out of every 2 recessions. And instead, it's just slowing. And a slowing economy is much less destructive. So I think that I don't see the economic cycle just turning exogenously. We don't know what endogenous shocks we'll get. But I think that's the macro environment in which we find ourselves.
Thanks, Jon. And your letters are great. So thank you for all of them. So Fed has recently cut rates. We're probably going to continue with a steepening yield curve. From a risk management standpoint, what concerns you about the current environment?
I was hoping you would say, what's the opportunities in the current environment?
We can do both.
Here's the issue. Go to ChatGPT and say, what is the history of governments putting pressure on central banks to lower front-end rates in periods of time when inflation is above target? And my guess is that unless they're hallucinating, the LLM will come back with Turkey and Argentina. And I don't know how you'll splice and dice my comments, but I just finished saying that the economy remains quite strong, although kind of slowing. So that means that it's probably fine to cut rates. I don't want to get cross with the White House, but inflation is probably being driven by tariffs, and that's probably transitory, to use a 4-letter word. So the odds that we end up like Turkey or Argentina are extraordinarily low. I don't want to be a Chicken Little, but I do think that once you start messing with Fed independence and central bank independence, you open the prospect for, as you said, a high inflation, a steepening yield curve in the back end doing that work, and currency depreciation and all this other fun stuff. If that's someone's base case, I think it's a wrong base case, and I think they'll likely lose money. In fact, most times when you're negative, and that's your base case, you likely lose money because the economy generally grows. But that, I think, is the risk we have to think about, as there clearly is a decent amount of political pressure on the Federal Reserve. And look, we've seen it before. The Nixon pressure on Arthur Burns, the LBJ pressure, that way I can be bipartisan, the LBJ pressure on the central banks, they didn't work. And I don't necessarily think it's wrong to be cutting rates now, to be honest with you. But I do think that you don't want a situation where you start divorcing monetary policy decisions from monetary analysis and inflation.
So maybe asked another way, since we didn't really cover the opportunities, credit spreads are really tight right now. You've written a lot about high yield issuers today not having as much leverage as they have in the past, and the market being much more higher quality. So how do you view the overall credit environment today?
Credit environment is not interesting. It's not a good time to just sit and say, I want to buy high yield. I know you have to hire a manager like Diamet to go find now. Look, high yield spreads. We'll use the high yield index, which is not necessarily representative of credit. In fact, the high yield index is much higher quality today than it's been almost at any point in my career. And the problem loans, the worst credits have been stuck into the loan market, parts of the private credit market. But look, when the S&P is trading at records, trading at 22 times earnings, the high yield index trades at under 300, and that's where it's trading. And generally speaking, buying the high yield index below 300 is not a good idea, because even though it can sit there for a long time, when bad stuff hits the fan, this is a family show, when bad stuff hits the fan, the high yield index will widen fast. And I can make all these arguments to you why, in fact, because of the quality of the high yield index, it's actually cheaper at 300 today than it's ever been. But the opportunity set that I'm excited about, and I remain excited about, and that we're prosecuting and frankly doing well with, is microcycles. We have an unprecedented amount of technological transformation and policy volatility in the economy right now, and it's hitting industries that have a lot of debt. So the telecom industry, for example, is the most boring industry in the world from the perspective of they spend money, they lay a line, whether it's coax or fiber, and you pay them every month. And in fact, we're all used to seeing our broadband bills go up every month, because what are you going to do? You're going to go get satellite? No. And all of a sudden, just as rates were starting to go up because of inflation earlier this decade, you suddenly have technological competition in telecom. So not only can you start laying lots more fiber cheaply to challenge coax, but low Earth orbit satellites, Starlink is the best example of this, start being able to provide speeds and performance similar. Fixed wireless to the home starts being a real option, offered by companies like T-Mobile. And so I've got businesses that had lots of debt because, hey, it's America. If you're stable, have lots of debt, all of a sudden facing technological challenge in a period of high rates. And so that telecom microcycle, which is a cycle because these businesses will continue to exist. This isn't mall-based retail where some of them are just not coming back. This is a cycle. All of a sudden have too much debt and can't grow into their debt and can't refinance. And so whether it's enterprise fiber, companies like Level 3 and Zayo, or it's consumer broadband, say SFR in France, or Altice USA in the United States, or more recently for us, wireless in the form of EcoStar, which we'll talk a lot about in our forthcoming letter, this telecom microcycle has been incredibly exciting for us. And the best part about it, and the reason you can come and we can make an argument to you to hire us, is you couldn't just go buy any telecom company because there's real differences in how they are set up to deal with this. And AI has overlaid it. And so Level 3 is one of our biggest winners in our second dislocation fund. We started investing in Level 3, which is an enterprise fiber business that's trapped inside a bigger business, Lumen, that has mostly consumer copper lines that your grandmother uses and consumer fiber. And our view was that Level 3 was poised to start improving its business, but that it was not necessarily going to be given credit for it because it was inside a bad hole. And so we had a position, a small position, thinking, as Level 3 improves, people will realize that Level 3 is better than its parent. Then we had a legal view that, wow, actually, they may have made a mistake and defaulted on the Level 3 debt documents by moving money in a certain way. That gets us a seat at the table to make Level 3 ring fenced. You guys can't see me, but I'm making a fence with my hands. I like to gesticulate. And so we grew the position there and we're able to do a deal with the company. And then finally, we realized everyone's talking about AI. Everyone's clamoring to buy NVIDIA stock. Everyone's clamoring to buy GPUs. How do you send out the results from the data center? You need fiber, lots and lots of enterprise fiber. Level 3 is going to become an AI play. And so we grew the position even more. And it was very successful for our funds. Now, go look at the ticker SATS, EcoStar, which is the company formerly known as Dish, which we started investing in when it was a declining satellite TV business that is known as EcoStar because it merged with a satellite service communications business, but is really interesting because of its wireless spectrum. Guess what's going to become the most important thing for the inference stage of AI? Spectrum. So we have enormous amounts to do in telecom. And it's not only the telecom microcycle, housing. We're in a fascinating microcycle in housing because it's the first one that I can think of in my career that is purely cyclical. So if I go to 15, 16 in energy, sure, oil prices collapsed, but some of the shale plays never came back. I sadly had an investment in the Mississippi Lime that never made it back, even though oil went back up because of earthquakes. You never want earthquakes near your oil play. So there was that element to it. You couldn't just say, hey, oil will go up, my investment will go back up. Or even in Silicon Valley Bank and Signature Bank that were cyclical responses to the rise in rates, you had the FDIC stop out risk. The government could just come take your asset. In housing, we went from a period where rates were abnormally low and everyone in America either bought a new house or refinanced. And then they quickly went to abnormally high or above average. We can debate when I was born, rates were in double digits. We can debate how high a 6% or a 7% mortgage is in history, but much higher than they've been on average. So it froze. The market went from 6 million home sales every year to 4 million. New home starts went from between 1.5 and 2 million to between 1 and 1.5. We all know this. If you have a 2.8% mortgage and you live in Cleveland and you get a great job in Cincinnati, part of moving is how am I going to go into a 7% mortgage? So we have this entire part of the economy that is totally frozen. Also, by the way, renovations are frozen. It turns out no one renovates their house unless they're moving to a new house. This will end. I don't know when it will end. We think that of the 4 million existing home sales now, somewhere between 2 to 3 million of it are from non-discretionary, death and divorce, where, I guess if you're divorced, you can stay in the same house, but that's not ideal. And so our point of view is that housing's fascinating because it's going to come back. And there were a lot of building products, LBOs in 21 or 22 that have too much debt and we're really excited about. And so don't buy the index. Go to a manager who's going to think about the microcycles and how the macro and the microcycles will play out and really concentrate on those industries. And that's what we're doing.
Are tariffs playing into this microcycle discussion? Maybe you could talk just a little bit about how you see certain industries being impacted by tariffs, how you've managed through all this volatility. And is this still a big focus? I'll say I was surprised that we ended up talking a lot less about tariffs the last few months with our managers than I might have expected.
Look, I personally got tariffs wrong in April in the sense that when I did the work in March, again, don't outsource your macro, on what reciprocal tariffs would be, they didn't seem that high. And so I thought reciprocal tariffs, and you can debate whether that's a good policy or not, I don't really have a point of view on it, would be almost an off-ramp for the administration. Say, hey, we're putting reciprocal tariffs. That's something that a lot of people can understand. Tit for tat, reciprocal makes sense. And it wouldn't impact the economy that much because it wasn't that big a tariff, actually. And then you could move on to deregulation and all these other things that were on the administration's wish list. And then sure enough, we got, the cardboard in the rose garden with much, much higher tariffs, and the market freaked out. And the question then became, okay, are these tariffs going to stick? What's the impact going to be? And the market right now is concluding the fact that the administration is committed to tariffs unless they mess things up. And if they mess things up, they'll back away of the tariffs. And the reason that is the case is they look when, I think it was the 10-year got closer over to 5% on April 9th, the administration sensibly backed away. So I think the reason that no one is really thinking about tariffs deeply is the view is that to the extent the tariffs start to hurt the economy, the administration will do the right thing by the economy and will take them away, reduce them, change them, et cetera. So that's why we don't talk about them as much, even though many of the tariffs that are in place today are as high as or close to as was threatened in early April. We've done a lot of work on the impact of it. We think that it's split in a variety of ways. It does end up ultimately in some consumer products, but not all. And it really depends on what the market structure is for specific things. Like bikes versus strollers was different the last time, for example. And so I think it's really nuanced, and you have to do deep work on some companies and some industries cannot afford to pass on the tariffs and have to eat them, and others can. And so you see that across a range of industries. And I think we're doing a good job as a firm modeling that. And I think that it's a political question as to whether if it does, say, cause longer than transitory inflation, or it does cause bigger issues, do you have a political change? And that's the market assumption. And I have no reason to dispute it.
So do you still find that there are companies and parts of their capital structure that are under overpricing what you see as the reality for the industry structure? Like, is it represented in your portfolio? And then maybe as a second question to that, when you think about maybe broader challenges like the legal challenge, in addition to what the administration might decide to do from a policy perspective, does that add uncertainty that maybe makes you just want to stay away from certain of these situations?
Look, we have tariff winners and losers, or a view on tariff winners and losers in the portfolio. I would say it's no surprise that parts of the retail chain have the hardest time passing it along. And so we have those views in the portfolio. There's certainly a decent amount of tariffs being collected today, huge sums of money being collected today. And so I think it would be foolish not to appreciate the fact that that's coming through in earnings. The IEEPA challenge, as we sit here, has not yet been decided by the Supreme Court, but the lower court has struck down, for the time being, the IEEPA tariffs. I don't know, to be honest with you, what the impact of it will be. If we assume, and I think the market consensus at the moment, well, Scott and I have a joke that if the distressed community has a certain kind of legal consensus, take the other side. And you see it in our portfolio decisions. We don't make big bets on legal because even if you think 9 out of 10 judges will go with you, if one judge goes the other way, well, you lost. And we don't like investments where one individual can determine if we win or lose, unless the skew is amazing. So I think that even if the Supreme Court backs the lower court and disallows the IEEPA tariffs, I think the administration has plenty of tools at its disposal to reinstate tariffs other ways, to be honest with you. So I'm not sure it will be an enormous change to tariffs. There might be a timing issue. Companies will get a lot of cash back and then have new tariffs because they can make claims. But I think, as you said, Sid, tariffs are not as front of mind for all of us today as we thought they would be in April. And that also applies to what would happen if the court rules against the government.
Maybe we could go back to AI for a minute. And I'm curious, just to start, what are your fundamental views of AI? Do you see it as a transformative technology? Are the thousands of companies that your research team is looking at using AI, do you think they will benefit from it? Will we see a productivity boost? How do you feel about the broader trend here and all the CapEx that's going in to fund it?
I think there's multiple questions. It's transformed my life as a portfolio manager and frankly, as a parent. I'm using ChatGPT and Perplexity and Claude and Grok multiple times a day. I don't do a credit review where I don't have ChatGPT window open. And I'm proud of the fact that we have a real integrated with ChatGPT Enterprise at our firm where all of our presentations, all of our emails, all of our Bloombergs are all integrated that we can search and bring up immediately and see how our theses are evolving. And we were going through a credit the other day and the analysts were talking and it felt a little who's on first. So I said, just stop. Let me have ChatGPT explain to me which of the two facilities that this company has is the problematic. Also, the ability to analyze data quickly for us is transformative. The ability to edit things quickly, to search quickly. So I think it's transformative to people who do research for a living, which is in many ways what I do. And already to think of living without it to go back is so different and wouldn't want to do it. The other question as to whether there'll be a return on invested capital from all of this, much harder. Now, in some degrees, you're seeing it like OpenAI, the number of consumer accounts they have and the way their revenue is jumping so exponentially is very positive. I think if you look at Anthropic, for example, which JP Morgan just did an interesting report, a private report on, or a company on Anthropic, which is a private company, the way they've broken into enterprises is extraordinary. We have invested across some of these companies. Grok integrated with Twitter and integrated with Tesla and presumably taking people to Mars one day across SpaceX ships is very differentiated and could serve a big role. My take is what's going to happen is that you will have a few models that become the winning models, most likely from the hyperscalers we know today. Those models will almost become commodities, but necessary commodities in the sense that everyone needs to pay a toll to use them. There's some competition, so it's not like utility where there's one company in your area that has a power plant. There'll be competition between them. There'll be slight differences between them, but the head start that they will have will be so enormous that people won't be investing anymore in trying to create new models. And instead, what AI will shift is who is making money after you pay the toll to the models with different applications. And are they the companies that own the models? So it's an integrated approach. Or is it third companies and other parties that are saying, no, we're selling you a wrapper, an OpenAI ChatGPT wrapper, a Grok wrapper on our software product or our consumer application. And the question is, will the hyperscalers earn enough over time from people having to access their models to have a good return on capital? And I don't know. Depends how much it costs to actually train these models and continue their lead. If you hear the hyperscalers talk, to some degree, what they're saying is we have these huge businesses and it's existential. If you hear Meta speak, if someone else gets a better model, what's that going to do to Instagram? So it's almost like defensive. To some degree, we started, if this is on such a lower scale, but if you'd met me and Scott in 2016 and you said, hey, as we were plotting this business, will you have a direct lending business? We would have said no, because we didn't see direct lending as complementary to syndicated credit. By the time we got to 2021, 2022, we were starting to lose relevance in our ability to do interesting new issue in the syndicated market because we couldn't offer borrowers either a private solution or a public solution. And I think part of what the spending is, which makes ROIC hard, is a lot of these companies are saying, we need to spend on this in order to protect our existing businesses, which are cash cows. So I think it's a really hard question that you asked, but that's a little bit of how I see it. But is AI transformative? It's just think about trying to go back to before you had the ability to use AI all the time. And probably the hack that I recommend to people is go to if you use an iPhone, go to the bottom ribbon and remove one of the four things. I removed my camera and put whatever LLM you like to use the most there. And then see how often you start using your LLM. It will transform your usage of it because it's right there. And it's really changed the way I use it. And we can't imagine existing without it.
Just sticking on AI for 1 minute more. As you mentioned, the hyperscalers are spending most of this money. Thus far, it's been financed mostly through their free cash flow. Mm-hmm. It appears that is starting to shift. There's moving more to a leasing model. There's the CoreWeaves and Nebiuses of the world that are helping them outsource some of this. And increasingly, debt capital markets are coming in to help finance this huge capital spend. How are you playing this within your funds, and how big a role is credit going to play in the next 3 to 5 years?
When Scott and I were first teaming up together at Anchorage 15 years ago, we had the opportunity to do a lot of new issues in shale and energy, the first high yield bonds that shale plays were doing. And we learned what was good rock, what was bad rock. We learned the different techniques for horizontal fracking. And shale is an enormous success. If you remember, a big issue we used to have in our elections was the national security implications of America being reliant on foreign sources of oil and hydrocarbons. And now we're awash in hydrocarbons, right? It's dramatically changed our foreign policy and prospects for the United States. So shale has been an unmitigated success with so many bankruptcies along the way and so many companies that don't exist and real winners and losers. And I think AI is going to be similar. AI is already transformative, is going to transform the world in a way that not even shale has, but that it's not going to be linear, that it's going to be a jagged line. There's going to be winners and losers. There's going to be people who make mistakes. And that's why the DeepSeek threat, I talk about something we don't talk about at the end of 25, that we talked about a lot at the beginning of 25. The DeepSeek threat that came at the end of January was all about, wait a minute, are the guys in the US going about this wrong? Are they spending much, much more than they need to, for example? And the jury is still out on that. And so when we look, and we are awash in financing opportunities that are adjacent to data centers and GPU financing. And at the moment where we focused is we don't want to be doing financings that leave us with a lot of residual GPU risk. So GPUs are the chips, so to speak, that NVIDIA primarily sells to the hyperscalers or to those who are operating data centers for the hyperscalers. And the acceleration in technology from generation to generation of the GPUs has been enormous. And so we don't think you can prudently take a view as to what is going to be the depreciation scale or pathway of these things. Similar, by the way, EVs. One thing, Hertz is an investment that we were very involved with during the COVID crisis. One reason we exited Hertz was once they got involved in EVs and Teslas, we didn't think you could actually model the depreciation curve that well in EVs relative to more traditional vehicles. And so we've tried to focus in situations where either the cash flows from really good credit counterparties pay us back most, if not all, of our money during that period of time. So relying on contracts with counterparties who have businesses we can analyze, or belief that liquidation value, not of the GPUs necessarily, but of what a data center might be worth for cloud computing, let's say, cover us, which means that we're going to have fewer and fewer opportunities, I think, because as we all know, it becomes a race to the bottom and there's more and more capital and people say, sure, I'll finance GPU depreciation. So we've looked at a lot. We have investments in the book, but we've been highly selective because I don't want to end up in the Mississippi Lime again.
Got it. I think it makes a ton of sense. Are there any industries you're looking at from an AI winner or loser perspective in the rest of the book? Which are the companies that may benefit within an industry because of their ability to spend on AI, their scale, et cetera? Is it impacting the book in other ways?
Yeah, a lot. What I would say is early in my career, as the internet was taking off, to age myself, there was a big debate over who's going to sell internet ads. And the Yellow Pages guys made the argument, it's going to be us. We have sales teams. We have sales forces that go out to the local dry cleaner and the pizzeria and all these places, and we're going to sell the ads. And so we're going to transition to digital directories. Turns out, no. Turns out Google sells the ads. I think that's how AI is going to go. So we at Diameter, and again, we're a meaningless company in the scheme of things. At Diameter, we started our own AI journey by talking to vendors of products that were designed for a finance firm. We will integrate your Bloomberg chats into AI. We're obviously regulated by the SEC, so we keep all of our communications. And so, hey, we are a company that will do AI for SEC-regulated industries to mine your communications. The product stunk. It did not work. It's improving, but the native Copilot that was in your Outlook really didn't work very well at first. And so we realized let's just go to ChatGPT. Let's have our compliance team really dig into what ChatGPT can do. And let's take guys who are native to AI and have them give us the wrapper to do AI. Let's not have a Yellow Page business sell our ads. Let's have Google do it. And so I think that a lot of businesses today who are hanging on, like I joke, the plumber is going to give you his AI solution. A lot of businesses that are telling you, oh, we don't do AI, we're going to give you the AI, they're going to be losers. Call centers are something that really can be transformed by AI. In fact, dealing with AI tends to make people who are upset about a bill or a customer service much more calm because the AI knows how to toady up to them a little easier. And so Are the call center companies going to be the ones to develop those AI bots, or is a new native AI company going to do that? And I think generally a risk is that the SaaS software ecosystem, which was based on it's very sticky, no one replaces us, is at risk because a lot of those loans that have been done to companies like that, those businesses are data standardization, data visualization, data workflow, and AI is great at taking non-standardized forms of data and comparing it and giving it to you. So we, for example, in our direct lending business, we've capped the amount of SaaS software at about 10% because we don't want to end up with companies that had been great in one era not being able to compete in the AI era.
Jon, maybe we can switch gears a little bit. I know you've found some interesting ideas in distressed or event-driven, and just wondering if you're leaning into any other themes right now. You talked a little bit about EcoStar, maybe talk a little bit about FTX.
FTX continues to be a good one for us. We are not a crypto fund. We don't invest in crypto, but FTX continues to work, and I'll get to that. I would say generally the way we think about distress is it should be episodic. It should be rare. The economy generally is good. Capital is generally available. If you are going into bankruptcy or you need a very difficult restructuring, you are probably not a very good business. And I don't think you should be investing in not very good businesses. Historically, I think the distressed community got a little over its skis. I was part of that, where the success in working businesses out that were declining, say beeper businesses at the turn of the century, gave the industry too much confidence that any company could be worked out. And the problem is that if the pie is getting smaller, it's very hard to do good. You want to be in a cyclical business, even if it's mediocre, not in a secular decliner. But FTX, you prime on FTX, and I will answer that bell. FTX was Sam Bankman-Fried's fraud, and it's a fun one because when it filed for bankruptcy right before he was arrested, their claims were trading at 10 cents on the dollar. And there were lots of swirling debates. Well, how big a fraud is it? What are the assets? And Bitcoin adjacent were collapsing at the time. And what I said to our analyst was, assume all the crypto they own is worth nothing. What else do they own? And what might that be worth? And so he went to go work on that. And then there was a liabilities question. Even once you're finished this thing, what are you going to get paid? Are you going to get paid in some kind of cryptocurrency that's worthless? Or are you going to get USD? And we felt strongly about the liability side, whether going through Lehman or Enron or MF Global. We've seen complicated financial customer account bankruptcies before with interlocking subsidiaries. And to me, it was pretty obvious that just like when we deal with a company with foreign currency assets and liabilities, if they file for bankruptcy in the US, you have a US dollar claim that's based on the conversion rate on the day you filed for bankruptcy. And so we felt strongly that we understood the way the liabilities would play out, which is something we think we're good at. It's, by the way, more and more a commodity. I think a lot of people could have reached that conclusion. We just got there quickly. And then the question was, well, what are the assets worth? So at the time, we thought, okay, the assets maybe are worth 20 cents on the dollar. I couldn't even spell Anthropic then, let alone know that their stake in Anthropic would be worth huge sums of money. And so we started buying claims. I think we started buying somewhere in the teens. Thinking, okay, it's worth in the high 20s between the cash that they have, the stakes that they have in some other companies, some clawback. Sam Bankman-Fried had bought some very nice apartments in the Bahamas. And that's a nice little investment, by the way, if I can make double my money on something. What happened as the case evolved is that, as I told you, we didn't want to invest in crypto, but they kept on turning the crypto into USD. To use gambling terms, instead of the crypto being the whatever it'll be worth, it turned into my downside protection, cash. And so we're buying at 12, thinking it's worth 25. By the time I'm buying at 50, there's 50 cents in cash, USD, because they've been selling the crypto. They sold Anthropic. I think they sold Anthropic when Anthropic had a valuation of 16 billion, and now I think it's 180. Bad sale. But it ended up adding cash to the estate. On top of that, this may shock your clients and the listeners of this, but there are a lot of criminals who had accounts at FTX. I know I was shocked to find that out. Part of getting your claim is you got to show up at court with a trustee with a passport and say, hey, this is my account. I had account number, XYZ123. Here I am. I'm John Smith. Give me my account. Give me my recovery. Well, for many criminals, it was better to maybe not show up and not take your money. So what does that do? The denominator starts to shrink relative to the numerator of assets. And so we have a case where I'm proud of the fact we got the liabilities exactly right. We have fewer claimants than we thought we would because the criminals don't show up. And we have assets that are worth a lot more because Bitcoin and other things they owned ended up being worth a lot. And so today, I think the claims old way are trading above 150 cents on the dollar. We have been buying all the way up. We've bought well over 140 cents. We've made ads because we think there's continuous value there. What do they say? Past performance is no indication of future success. I don't think there's going to be a lot of FTX, but the fact that we could analyze it quickly and we're able to think about the legal risk, the asset risk, and then be involved and react and source them, I'm proud of it. And I don't think we'll see many more of them, but it's been a big winner for the funds and a fun one. I guess the way you could think of it, it was a fraud wrapped up in a scheme, and we like those.
Rare, but a unicorn of distressed investing.
Sure.
Maybe we could close out by just really high-level thoughts on where you're seeing the best opportunities right now. And I want to frame this a little bit as public versus private. If you could comment a little bit about the explosive growth of private credit as an industry. It's up 5x over the last, whatever it is, 7 years in terms of assets. But what are you most excited about? What, as allocators, do you think we should be most excited about at a high level from an asset class perspective in credit?
Obviously, this will be self-serving to the products that we have available.
But the whole lineup. Got it.
The whole lineup.
Yeah.
No, look, I think I'll go very general and then I'll give you more specific. There are times in life where you just want to buy an index. And there are times in life that you want to pay fees for a manager. And frankly, when the world's on fire, you should buy indices. It's scary to do it then, so not everyone does. But in periods like this, fundamental credit work and then risk management really what matters. Let me step back. One of the problems after the financial crisis was that there were funds that had been doing illiquid stuff with fund structures that all the money could come out monthly or quarterly, the asset liability mismatch. So almost everyone in the industry, managers, allocators, have figured out that's bad. So almost everyone doing direct lending of any stripe, whether it's rescue lending, capital solutions, top of the capital structure, LBO finance, non-sponsor lending, has an asset liability structure that works in the sense that there can't be a run on the bank or there can't be a run on the lender. What that has done, I think, is it's made many managers stop doing risk management and stop doing demanding premium to be illiquid or premium to be illiquid. And so I think it's a time for you to prive, hey, how are you putting together this illiquid book? Are you being paid for illiquids? Because there's lots of illiquids now that you're not being paid for, particularly in the pref and mez space where someone will come and say, hey, our secured debt trades at 9, could you do an 11.5% pref? You probably shouldn't do that pref. But if you have a pref fund, you may say, hey, I'm going to do that for my pref fund because I need to put assets into my pref fund. And that's what the market is today. So I think active management with risk management, and I think where Scott and I background, Scott comes from a trading risk background where he's constantly assessing the risk of everything we're doing. And I come from a research and restructuring background. This is self-serving, but that's how we complement each other. I think direct lending, you mentioned, the 5x growth. That is scary. Spreads are compressing. But look, there's also been a change in the way banks lend. Banks have, in many ways, said, we would rather lend to the Diamet BDC or someone else's BDC than make the loans ourselves. It's more orderly. It's better from a regulatory perspective. Not to say banks aren't doing loans, and they are. And we really love partnering with banks. But that's allowed there to be much more supply. And so you've got to look at the supply and demand of private credit. And that mismatch is not as big. I think you're going to see that next in commercial real estate, where traditional regional banks that had been doing commercial real estate for years, particularly new construction, don't want to have that on their books anymore. And so you'll see specialty finance come in and take that in kind of an orderly way. And so I think direct lending continues to be a place to allocate. I think finding ways to combine types of lending, say, hey, can I be in a product that offers me some direct lending, but also has liquidity in it, so I'm not just totally trapped in vintage risk, which I think are the two worst words for someone investing in an alternative. Oh, sorry, the 2014 vintage or the 2021 vintage, that just stunk. Having a fund that allows the manager to maneuver and protect capital even when the world develops in a way that he or she didn't expect, I think is really, really important. Not being so limited. It's just the mezz fund. I would look askance at. And then more specifically, to repeat what I said before, invest around microcycles. Think about telecom, housing, healthcare. These are really incredibly interesting places to put money to work, where you can have a situation where other people are afraid and you want to be investing when other people are afraid. If you do it poorly, being afraid will be the least of your problems, but that's how you can produce alpha over time. And that's the type of alpha that I assume, Sid, your clients are looking for to pay our fees. And so that's a little bit both self-serving and not self-serving about where I see that opportunity.
That's really helpful context. Jon, I know we're bumping up on time here. Just want to thank you for all your comments today, for taking time out of your day, for the many years of partnership and good performance. And Erika and I will stick around. You are welcome to stay, sir.
No. I'm going to go. I don't want to hear you criticize me for talking too fast. I know I did.
We're not going to be at 1.5x this time, but that's totally fine.
One day I'll learn not to be the micro machine man. But anyway, I really appreciate this. The partnership with you guys has been extraordinary. What I say to the team here all the time is when you are allocating client capital, you should think of it as almost like a holy thing, because this is coming from so many different places. It's people hired you to do this. And every time you put that money to work, you should be terrified because it's not your money, it's someone else's money. And really, if I'm pushing you really hard in a credit review, it's because it's not our money. And that's why, frankly, Diameter performance has been better than my own personal investments in things over time. And so the faith you've put in us and the faith that your clients' money, we really appreciate it and look forward to chatting again.
Thanks, Jon. Cobbler's shoes, as they say.
Thank you.
We'll talk soon.
Thanks, Jon.
So, Erika, a lot to absorb there. Far-ranging conversation. What were your biggest takeaways?
Yeah, Sid, there was a lot to absorb. What a fun conversation. I'll just make a couple points. I really liked his comments about multiple ways to win, looking at credit, liquidity, assets, restructuring. You can look at everything from a lot of different points of views in the way that Diameter's investing. I love the fact that he focused in the beginning on team, the offsite once a year and really drilling in for every analyst focused on industries. I think it's great to talk with somebody on the macro because this has been such a year that has been really not only driven by fundamentals of companies, but you really do have to be macro aware, which is what he said. And look, we'd agree the primary data is weird. Second quarter showed that we're not in a recession, but his comments about AI eating the world and really dominating everything is a really interesting way to think about it. Another, when we talked about opportunities, just being really excited about microcycles. I like how he said tech transformation and policy volatility, and it's hitting industries that have a lot of debt right now and being able to take advantage of that. You'll talk a little bit, I'm sure, about AI, but I did think it was really interesting that, in the beginning of the year, all we talked about tariffs, and it's just not as front of mind anymore today. And then lastly, his comments, which I think are really good ones, is we just shouldn't be invested in not good businesses. Sid.
It's hard. I've had now conversations with him over the last 10 years. And the first thing you always notice is with anybody at Diameter, the high energy, the intensity, and the speed. And I think within a relatively sleepy investment area, that's a huge differentiator, having that intensity. But also, in order to be fast, you need the depth of the team and the industry expertise and 100 people at the firm dedicated to that process. Microcycles, we talk about it with them all the time, that industry alpha in what's otherwise, a fairly uninteresting credit environment, if you can be more opportunistic and allocate more to those areas where you're seeing that kind of fundamental change, I think that's a huge advantage. Another thing that stuck out to me is how the credit industry is changing. I'm generally a believer in this idea that there's been a secular shift out of the banks and into the private credit markets, which accounts for a lot of this growth. So it's less that we should be worried about a cyclical rush of capital into this space that's going to lead to negative outcomes. And also that generally the liquidity that these private credit managers are offering lead to a pretty well-matched asset and liability structure. The benefits of scale also, it resonates with me. The scale that you might need in distressed investing and influencing restructuring, the scale in private lending and being able to lead deals, within reason. And then, the AI comments. I think it's been pretty dramatic, the conversations we've had with managers in the last 4 or 5 months versus 6 to 9 months ago, both their usage of AI in their own research processes and getting that used across the team. I think the conviction in it as a transformative technology and the potential threats that it poses to a number of different industries, businesses, et cetera. And I think this is where we're spending a lot of our research time is on what may be the winners in software, what may be the winners in other industries, for example. So I think it's overall just pretty unusual, unique to have a credit manager thinking so deeply, as you say, about these industry themes, the broader macroeconomic setup, as well as being able to go very deep in a single situation like an FTX, as he described. But really fun conversation, and hope everyone out there in our listening world enjoyed it as well, and tune in next time.